All right, everyone, welcome back to the Integrating Investor. This is a big news right here. This is our second show. And you know why that's important? We are officially a series. We're no longer just one show. So welcome back. Thank you for joining me. Glad you're back. If you're new, thanks for coming. We are going to do, I'm pretty excited to kind of go down and explore some of these topics in a little bit of a different way that the traditional world kind of handles them. Should have said this last time. Please, if you're watching the show, do me a favor. Can you like and share it? It's very important. We're a new show here, trying to build an audience, extremely hard. I rely on people like you. This is a trade, value trade. So I really appreciate if you can do me a favor and share it and get it out there. And you know what? Why don't you just take a second right now? Just click the like button right now, right? It's no harm. And if we go on and the show, you don't like the show, you can unclick it later. That's all right. We won't hold it against you. Also, of course, you can follow me on Twitter at Seth Levine 2. That's the best way to get a hold of me. And I really recommend checking out the website and subscribing to my monthly emails. I write once a month. You subscribe, comes right in your inbox, and I will be putting out a new piece on Sunday night, Monday morning, depending on where you are. And yes, it's another one on crypto. You could ask me about that in the chat if you like. I'm not going to get into it here. We're going to be watching the chat. And again, I should say, please use that super chat. So if you have a pressing question, I will definitely see it if you use that super chat function. Without further ado, we will move on. And of course, unfortunately, this is how I will start every show. I will start with the disclaimer slide. Again, I don't even know if I need this, but this is the world we live in. These are just my personal opinions and not investment advice. It's not anyone else's anyone else's opinion but mine, right? There may be conflicts of interest. Do your own work. We all know how this goes by now. So we are back. If I could figure out how to stop sharing the screen, I will. There we go. Stop sharing the screen. And we're back. There we go. So today we have a very exciting episode. We will be talking about investing, right? So last time we left off, we were talking about investing, right? What is investing, right? How do we do it? What is it in kind of deep philosophical terms? And we came up with this formula, right? The investing formula. And I will again share the screen so you can see it. Here we go, right? We talked, but in talking with it, I had to realize I had to update it. It wasn't complete. So I fixed it. And you can see right here, right in the middle, we have the capital commitment. So investing really is the act of taking existing capital, committing it, right? Typically buy. So let's just use buy for short, right? Buy something, right? And then after some period of time, we have another pile of capital. Maybe it's more, maybe it's less. But what this means is really all the magic happens in this act of selection, right? The commitment of capital. Let me stop right there. Yep. Right. So this is really the only thing that we can control for as investors, right? And because this selection is the only thing that we can control for, it's why so much of the investing sort of, focus is on this, right, is on the selection, right? That's why it's a topic of study, because this is really, from an ethics perspective, this is the only thing that we investors can actually do and control. So if we remember our task as investors, right, there are a number of questions that we are going to, that we need to answer. First, we need to answer what happens, right? We need to do something and figure out what happens, right? We committed our capital, but it's not just what happens, it's what happens to what, right? What happens to what in the world? But not only what happens to what in the world, what happens to what and when does it happen, right? And also how it happens, right? And then of course, what are we going to do about it, right? So, but we need to remember our tasks, right? And really what I'd like to cover in this show are what I'll call the metaphysical perspectives of these tasks, right? The what, when, and the how, right? That's what I'm going to get into here with a framework, right? We're going to talk about the what, the when, and the how. And I'm not even gonna touch the, what are we gonna do at all? Because quite frankly, that is just a whole other ball of wax. So the what, when, and the how, that is what we're doing here, right? So investing is the act of selection, right? We need to break the, so what does that mean? We have to break this down into what, when, and how. The what, when, and how, right? We need to know, what are we going to own? How are we going to own it? And then when to own what and how, right? So that's a whole mouthful, right? What are we going to own? How are we going to own it? And what to own, and when to own that, what and how, right? Obviously, there are other questions of where and why, right? But those aren't relevant, right? Where are we going to own it? That doesn't really make sense in investing. And why we own it, why we want to own something, that should really presuppose the entire investment process, right? If you don't know why you want to make an investment, we don't even get to what, how, and when, right? So why do we do this? Why do we have to break down this into what, why, and how? Well, we need to map our ideas that are in our heads into investments, right? So we may, investing is connected to the world. It's not disconnected. It's not just numbers on a screen, right? Those numbers on a screen correspond to actual real world events. And we need to map those ideas of what's going on into the real world into an investment on a screen or a concrete investment. And we have to watch how the price of that investment fluctuates. That is what investing is. So there's an art to this all, right? The art of investing is really the way in which we can express a trade, right? Because there are many different ways to express trades. And in fact, you could have the same sort of trade thesis on, you could express it differently, and you could have completely different returns, right? This is why similar investments can have different, dramatically different investment returns. And that's not even going into the trade management, kind of how you manage your trade once it's on. That, again, is kind of a separate topic, not what I'm going to cover today, but that is why the expression is so important. So let's start with an example, right? This is very abstract. Let's make it concrete, right? Let's say you start with a thesis, man, I love smartphones, right? I just think they're going to be let's go back 20 years, right? Or 10 years. I love smartphones. They're going to be the best thing since sliced bread. They're going to be everywhere. I want to invest in smartphones. I think I can make money off of smartphones. I can commit capital to smartphones and over a period of time, make money, right? Well, how are you going to do that? Right? Well, there's a lot of ways you can do it, of course, right? You can actually go and buy a phone, right? You could buy a bunch of smartphones wholesale and sell them retail, right? This is what a phone reseller would do. You can open up a kiosk, right? You buy wholesale, sell retail, right? You can also go buy phone components, right? Like chips and screens and, I don't know what goes into, a smartphone, but, you could buy the stuff that goes into it, right? You can buy the commodities like plastics and rubbers and metal, thinking, well, demand for all these commodities are going to go up if smartphones take off, and the demand's going to go up, so the price is going to go up. Then you could go buy companies, right? The manufacturers of smartphones, right? You could buy Apple, or you could buy Samsung, or you could buy both, right? Maybe you want to buy both. All right, well, maybe let's pick Apple, right? So maybe you pick Apple, but what are you going to own? Are you going to buy the stock? Are you going to buy the bonds? If you're going to buy the stock, you're going to be a long short. Oh, okay. Well, I mean, if you want to be put a long short strategy on, well, you can do it, maybe long short Apple and the S&P, or, are you going to arbitrage it, right? You're going to buy, you're going to short the bonds and buy the stock. What's called a capital arbitrage, right? But maybe you want to buy options, right? Oh, no, maybe we'll buy options, right? Okay. So if we're really bullish Apple and we want to buy Apple options, how are we going to do that? We're going to sell, we could buy call options, right? We could also sell puts, or we could buy some kind of combination of calls and puts at different strike prices and different time expirations. And there's just, you get the point, right? There is just so many ways in which you can express or map a investment thesis in the real world to actual investment, concrete investments, right? And there's just no avoiding this what, how, and when, right? It's even when your investment thesis is clear, the expression of it may not, right? So even this smartphone example, it's not really clear maybe what you want to do. And just to give you a sense of, let's see, I'll share my screen again, just to give you a sense of what I am talking about. So here we can see, this is a chart on the top, right? I have Apple in blue, what's it? Apple, Samsung, and Apple in blue, Samsung in purple, and Verizon in green, right? These are three different ways to play smartphones, right? You have an Apple smartphone, you have a Samsung smartphone, and you also have, maybe Verizon, right? Maybe the carriers are going to make more money because they're going to sell more data plan. And how you play this is a 5-year charts of their stock, all three of their stocks. And you can notice they're not the same. While yes, they're all kind of moving in the same general direction over certain periods of time. Look at 2017, 2018, right? If you bought Verizon, you wouldn't have made any money, but if you bought Apple, you would have made the most amount of money, and not quite as much. Samsung, you would have made the most amount of money, but not quite as much in Apple. And of course, these scales are different, right? So this doesn't even do it justice, right? The scales are different. And what you can see too is right on this bottom here, like these are the volatilities, right? These are one day volatilities of these. And what is that? 1 month volatility. And what does that mean? Well, it's just the amount that the price moves around. And what you can see is these stocks in this example, the price moves around very differently. While they may follow the same general course, they are not equal. And so what you do here will determine what your actual investment returns are. So it is very critical, these questions of what to own, how to do it, and when, right? So how are we going to do that? That is a whole mouthful, right? Well, we need some kind of, to me, you need some kind of mental model, right? You need some way to view the world, some lens that maps the real world into investment terms, right? So I've kind of played around with this idea of collateral, leverage, and volatility. Collateral, leverage, and volatility, right? What do I mean, right? So collateral is really the what, right? What are you going to invest in? It's collateral, it's a thing, right? How are we going to invest in it? Well, to me, really what you're looking in that how question is a function of leverage, right? And when, right? Timing. When do you want to invest in these strategies? Again, I view through a volatility lens. So let's dive into those a little bit more, right? Collateral, right? Let's talk about collateral first. To me, collateral is the foundation of investing, right? These are really the things that you exchange your current currency for that have a direct use value, right? They could be for consumption, like maybe you want to go, buy gas and put gas in your car, right? So oil and gasoline can be that, or maybe you're going to like accumulate cash, right? So you can buy a bond, right? A bond is just a stream of cash flows, right? So that's another thing you can. Or maybe collateral can be something that has like intangible value, like a trademark, right? You're going to go and you're going to buy a trademark. Right now, you have the trademark that could appreciate in value, and even cash, right? Even cash is a type of collateral, right? Maybe you're like, I want to hold cash right now as collateral because there's utility there to mediate exchange. So collateral really are just assets in the most basic form, right? They're the iPhones and sneakers and advertising slots and computer code and electricity and transportation and cloud storage, and even attentions are a type of collateral, right? That's what TV media does, right? It gathers our attentions. So collateral is really the goods and services that we trade for in everyday society, right? They are the things and the services. So as an investor, it's really collateral's value that we ultimately seek exposure to. And this is what we speculate on, right? Collateral is the what when it comes to investing. Now moving on to leverage, right? Now, when it comes, let's be honest, right? Most collateral sits outside the realm of financial markets, right? If you can't buy, let's stick with the iPhone example, right? You can't buy an iPhone on the financial markets, right? So if you want to act in the financial markets, you're limited to your subset of investments, right? And the truth of the matter is we rarely cross paths of collateral in a pure investment form in the investment markets, right? More commonly, it's found in the presence of leverage. Well, you may say, Seth, like, what about commodities? I could go and, I could go buy some gold, or I could buy pork bellies, or I could buy wheat, right? It's soybeans, right? Like that's a commodity, right? Why isn't that just a pure collateral asset? Well, in the financial markets, like commodities aren't really commodities. They take the form of futures and forwards contracts, right? Futures and forward contracts. These are really rights to purchase things and in quantities. And I don't know what a going contract is, but let's say you buy one contract of of corn, and that is a right for you to purchase X amount of corn on a certain date and a certain quantity, right? So it's really a contract. And what that is, if you boil it down to, it's a leveraged exposure because you're buying multiple. You have a right to multiple quantities. However, there's an even more common form than just of leverage than just commodities, right? Stocks. I mean, stocks are leverage collateral. Now, a lot of people we don't think of it that way, but they really are, right? And they're leverage collateral in two ways. One, they have operating leverage, right? So if you think about what a very basic manufacturer, right? They take raw materials, they take money, capital, they invest it in plants and equipment and people and research, all these things so that they could take raw material of low value and transform it into high value. Now, there was an initial investment, and the more kind of throughput through the more kind of volume they have through their process, the higher the profits typically. And this is because of operating leverage. Now, of course, companies also borrow money, right? So they have financial leverage too. So stocks have both operating leverage and financial leverage usually, right? And leverage is just inescapable in our efficient financial markets because our economy is tuned to efficiency. So I really think of leverage in terms of how collateral is owned, right? Leverage is how collateral is owned. This brings us to volatility. So volatility, how I think of it is, there's a lot. This is a confusing topic. But what volatility really is it describes the price fluctuation of investment values, right? It describes how investment prices fluctuate. So the more something gyrates, right, the more a stock price gyrates, the greater the volatility it is. Now, it's often used synonymously with risk. And I get that, right? If you look back from an investing perspective, your real risk is kind of price, right? So to look back and see how historically how price used to fluctuate, and even on a forward basis, kind of what the implied price fluctuation is, that is the risk of investing, because again, investing is about taking money and making more money from it. However, I kind of view it a little bit differently in conceptual forms. I see it as a scorecard of forecast accuracy, kind of like a voltage gap in electricity. What do I mean by that, right? So why is it a scorecard? Well, if you think about what volatility really is it is a change in price. So if in theory, I'll just go quickly, in theory, if markets are forward looking, right, there is an expectation, right? So if you were to get everything right, let's say you could forecast perfectly, there would be this volatility of zero, right? The price would always be right. However, the price is not always right? The price, what you think the price moves all the time, right? So what you thought the price would be today is not necessarily what the price is. So the greater the volatility of a stock to me is, that tells me the greater the lower the forecast accuracy there is out there. And I can come back on that if you want. So because there's this, because we're trying to figure, because when we look at kind of how much a stock moves around, let's use a stock, for example, how much a stock moves around, I see that as the when of investing, right? Because it relates to price movements, we can use volatility to determine when to apply leverage, and by extension, what forms and amounts to apply leverage, right? So if something is moving around a ton, the volatility is really high, do we really want to apply a lot of leverage to maybe something that has those kind of characteristics? Well, your margin for error of being wrong is far greater then. So maybe not. Maybe if volatility is low, then maybe you want to do, then maybe it's the right time to maybe apply leverage, or maybe vice versa. Maybe when volatility is high and things are moving around a lot, it might be an unstable situation. So you're like, you know what, this is a good time to buy because I think the volatility will collapse. And there's a lot of literature about this, and vice versa. So again, confusing topic. I will just leave it there. So just kind of moving right along, right? Selecting So investing, right? We're back to investing. We need to select what this active selection is, right? It's selecting what, when, and how to invest your capital, right? And we must have some criteria, right? Because when you think about investing, like collateral gets all the attention for the most part, right? Do I want to buy stock A or stock B, right? Do I want to buy Apple or Samsung, for example? But if you think of it, it's such a small part of the actual equation, right? And I have a great example. Let's use gold, for example, right? I'll share my screen with you right here. This is gold. So what I have here in blue, and again, these are different scales, so you have to take that into account. Blue is the price is GLD. That is a gold future ETF. So it's just an ETF of 1 month forward gold contracts, and it just rolls each month. Okay, we no need to get into it, but that is basically your as clean an exposure to the gold spot price as you can get in without owning physical gold. The purple here is GLD. That is the gold miner index, right? That is the guys who actually mine the gold, right? So what we'll know here is they're not the same, right? We could see that the returns are not the same. This is a 5-year period. It's just random. You could see on the bottom, the volatilities are not the same of the two. And what we can see is the greater an investment's volatility, the more leverage impacts the returns on both a positive and a negative perspective, right? Let's look at this period here of the big spike in volatility. And you can see because GDX, the gold miner, has a higher volatility, the downward, the correction downward was more negative. So let's just take, again, the price of gold. And let's say you have $100 rise in the price of gold, right? Well, that's going to impact an investment in GLD, right? The gold ETF, and the gold miners very differently, right? And it'll even impact kind of the gold miners themselves differently, because some gold miners will go out and they'll hedge their production. But again, this is sort of no need to kind of get into get into all the details there, but just to illustrate the point, right? So our expectation for volatility will impact how much leverage we want to use at any given time, right? We probably want to have positive leverage when that volatility is going to explode in our favor, and we want to have and we want to have and we have no leverage when in the opposite situation. So really, when I think about, right, what investing is, right? So we talked about investing as the art of selection, but there's another way to think of it. It is really, if we were to model that art of selection, map it into investment terms, we could think of it as, some kind of combined expression of collateral, leverage, and volatility, right? I know there are many ways to do this, of course, and this is a personal choice. And we all need some kind of investment philosophy, because we're talking about selection, right? Investment is an act of selection. And what does that mean? Selection is about choice, right? And choice means volition, right? So you need some kind of framework in order to guide your decision-making process, right? So this is just one way to think about modeling these choices. There are many different ways to think about investing. I've started to think about things in this collateral, leverage, and volatility framework. I don't know. I hope it's helpful. I hope that made sense. It's kind of where I was going to leave it here today. So unless, if you have any questions, feel free to use that super chat. Feel free to ask anyway. We'll see what we can cover. If there's none, then we can leave it there and call it a day. So I guess if there's nothing there, then we'll call this a wrap, and hopefully I'll see you all next week. We'll get into some new topics.